The Bank of England. Quite simply, the central bank of the United Kingdom. Its Monetary Policy Committee, or MPC, is responsible for keeping UK inflation in line with the government's target, currently set at 2%. But how does it do that? Primarily by setting the Bank of England base rate, which is the official interest rate in the UK. This is the rate of interest charged by the bank for overnight loans to commercial banks. When the base rate is lowered, it's cheaper for banks to borrow money from the Bank of England, which encourages them to borrow more and lower their own interest rates. This in turn reduces the cost of borrowing for businesses and consumers, encouraging them to borrow and spend more as well. The result can be increased spending, economic growth, and a rise in inflation. If the bank wants to reduce inflation, it can put the base rate up. This increases the cost of capital, reducing borrowing and spending across the economy. Sometimes the bank finds the economy isn't responding to a low base rate. If this happens, the MPC may use its quantitative easing programme. This is an asset purchasing facility in which the bank creates new money electronically and uses it to buy assets such as government bonds or high-quality commercial bonds. It buys these mainly from businesses, so they have more cash to spend and invest. This boosts spending across the economy, which can increase inflation. If the bank needs to reduce inflation, it may sell some of the assets to try and reverse the effect. Traders often pay close attention to changes in the bank's policies, as they're likely to affect the price of some foreign exchange pairs, commodities, bonds, and stocks. To learn more about trading, join IG Academy. To start trading, open an account.